Okay, so in this lesson, we're going to look at the Federal Reserve System. In our last one, we looked at money. In this lesson with the Federal Reserve, we'll look at how money is distributed within the United States, how it's controlled and regulated, including also how banks are regulated. So we'll begin with the question of what is the Federal Reserve? It was created in 1914 by Congress, followed a series of bank failures that ultimately led to problems within the economy in terms of what we would call financial panics. The term we use today would be recession. And that led Congress to determine that there needed to be some entity which tried to regulate and control and prevent future bank failures. So it was a central bank designed to regulate the health of the banking system and regulate the quantity of money in the economy. So that's two of the primary purposes of the Federal Reserve. They're going to regulate the health of the banking system. They'll regulate the quantity of money in the economy. It was based on a belief that if banks were left to operate on their own without supervision and common policies, they would collapse and create an economic panic. And the idea would be that if every bank just kind of did their own thing and nobody supervised them, then there was no way to determine if banks were simply loaning too much money out or doing some different things which would cause them to collapse. And so they wanted to make sure that there was more control over the banks in terms of supervising their activities. So when we look at the basic structure of the Federal Reserve, at the bottom are the American people, and it's the households that deposit money into the banks. So from our perspective, there needs to be some confidence within the banking system so that we're willing to actually deposit money into the banks. Now, there's also other depository institutions such as credit unions and saving institutions, which are a part of our basic system, but they're not exactly member banks. And so there's a difference there. The member banks of the Federal Reserve, these are grouped into three sizes that elect directors to Federal Reserve banks, along with those chosen by the Board of Governors. So you have these Federal Reserve banks, and they're located, we'll look at a map, they're located regionally across different parts of the United States. The easiest way to think of Federal Reserve banks is they're simply the banks of the banks. So if a bank needs to borrow money, it does so from a Federal Reserve bank. So there's 12 regional banks, each with a 9-member board of directors and a president of that board. Now the Federal Reserve banks do not loan money to these credit unions and savings institutions, so therefore they're not technically a part of the system itself, but in terms of the overall financial system within the United States, they are a part of that. At the top are the Board of Governors. So the Board of Governors, it's 7 members appointed by the President and confirmed by the Senate. So there's no elections taking place here. Now among the 7 is the chairman who leads the board and speaks before Congress, and this person is chosen by the President and confirmed by the Senate. They're the name you hear, like Alan Greenspan for a long time was the name you heard. So they serve 14-year terms. And this chairman is a 4-year term and no limit to the number of terms. One of the reasons for the long term of the board is so that it expands the presidential elections themselves. That way you don't have boards which are specifically elected to be basically handled by the president. The 4-year chairman term, often chairman of the Board of Governors, they end up serving longer than presidents are serving anyway. A lot of them you see are repeated across different presidencies. And then in the middle, between the Board of Governors and the Federal Reserve, we have what's called the Federal Open Market Committee. And it's 7 members of the board plus 5 of the 12 bank presidents. And its purpose is going to be to regulate the money supply through different actions that it has to it. So that's kind of how this structure of the Federal Reserve breaks down. So this map shows the location of each of the Federal Reserve banks and the regions that they cover. Remember, the purpose of these Federal Reserve banks is they are responsible for loaning money to the banks themselves. So when banks need money, for example, banks don't always carry the amount of deposits that people actually have. So when a bank needs to borrow money to pay off, maybe somebody has taken a large withdrawal, they get that from the Federal Reserve banks. So let's look at the Federal Reserve responsibilities. So the Fed has 3 primary responsibilities. The first 2 tasks are largely the responsibility of the regional banks. So the 12 regional Federal Reserve banks, they work to regulate the local regional banks And they monitor each bank's financial condition and facilitate bank transaction by clearing checks. So what they're doing is they're making sure that these banks are healthy in the fact that they are able to handle the amount of money coming in and going out, so that the bank isn't pushing more money out than they actually have available as deposits. The bank has to equal out the amount of deposits coming in and the amount of money that's being loaned out, because banks, even though you may deposit $1 million, that bank is not carrying $1 million. And so that's one of the ways in which they're monitoring the condition of the bank. The other thing they're doing is clearing the checks, which just ensures that the amount of money is actually there. So a big part of this is making sure that the amount of money that's being sent out of a bank is equal to the amount of money that's being brought in. So they're ensuring the health of the banking system. They need to create confidence in the banking system, which creates confidence in households to deposit money in those banks. The Fed also makes loans to banks who need to borrow. And this ensures that banks can cover loans and deposits when things and transactions are taking place. This is the primary source of bank failures in the past, is that what banks were doing is the banks were loaning out more money than they were actually taking in. So when people came to withdraw money, essentially if 30 people showed up, the bank only had enough to give out money to the first 10. The next 20, that's it. They just lost their money. And the Federal Reserve today, of course, you'll see this FDIC, the Federal Deposit Insurance Corporation, actually insures banking deposits up to a certain amount of money. And so that kind of prevents this from taking place. Now, another major task is to regulate the circulation of money in the economy. As we've talked about previously mentioned, the Fed has the ability to increase and decrease the money supply. When we were talking about why the economy fluctuates, one of the things we talked about with shifting aggregate demand is that aggregate demand, the primary method or primary reason that aggregate demand is shifting to the left or to the right is because of actions of the Federal Reserve. And so when we see, for example, the aggregate demand increasing, then that means that the Fed has increased the amount of money that's in the supply. It ultimately leads to that increase in aggregate demand. And so they have the ability to inflate and deflate price levels as they see fit within the economy to basically keep that business cycle line as close to the trend line as they possibly can. Okay, let's look at monetary policy. So decisions made by the Fed concerning the money supply make up the monetary policy, and monetary policy is determined by the Federal Open Market Committee. And essentially what monetary policy is, it's basically control of the money supply. How are we increasing or decreasing? Why are we doing that? So the Federal Open Market Committee, that's this group, consists of 7 Board of Governors plus 5 of the 12 district bank presidents. So that committee will use different methods in order to increase and decrease the amount of money in supply. One of the primary methods here is going to be the ability to increase and decrease the interest rates with which banks borrow money. So they meet every 6 weeks to review monetary policy. And when they sit down and review that policy, that's when they'll make changes to the money supply based on the different actions that they have available to them. So the primary way the FOC controls the money supply is through open market operations. This is open market operations, the buying and selling of bonds. It's a very simple way that they can control the money supply, because when you increase the money supply, the Fed buys bonds. So if the federal government is buying bonds, they're putting money into the economy, whereas to decrease the money supply, they can sell bonds into the public and thus pull money out. And this is a long-term control. It's one of the primary methods that allows them over time to control putting money in and pulling money out of the economy. So let's look at the bonds. So this is what a bond looks like. So when you're looking at a bond, it's a U.S. government bond from 1936. So this is a Depression era bond. It's a $50 bond with a 3% interest rate, which means that when the bond has reached its maturity, it will pay out the $50 plus the interest earned from the 3%. So the bond was scheduled to mature on June 15th of 1945. So this bond essentially is covering a small amount of time. The owner will receive $63.50. The longer the term of the bond, the higher the interest rate will be. So the government pays interest on the bond, and it's incentive to purchase. Essentially what the government does is the government is saying, okay, we need your money. So in order to buy money from the people, this is what they use. They sell bonds to the people, which gives the government money with which to do different things. The incentive to purchase the bond is the interest rate. So if you're able to hold out till the bond matures, then you'll receive the amount back plus interest on it. So this removes $50 from the current money supply. So you can see here this 3% adjusted service bond of 1945 based on that $50. And then down here is the bond schedule and maturation date. So value of this bond on date shows. So it also gives you an idea of how much that bond is worth on particular days. So it removes money from the current money supply, but it's going to add money to a future money supply. That's essentially what's taking place. So to increase the money supply, remember the Fed will buy government bonds from the public. And then to decrease the money supply, the Fed will sell government bonds to the public. So let's look at the money supply. And then, so this is the amount of money in circulation. It's called the money stock. And so it consists of currency, which is the paper bills and coins that are in the hands of the public. So the original currency values, we had said, were based on the gold standard. That's no longer the case. After August of '71, currency values were based on the strength of government policy. So that's why we see fluctuations within the price level so much more than we had in the past. The other part of the money stock are demand deposits. These are bank account balances that can be easily accessed, i.e. credit cards, checking accounts, these types of things. So when we talk about our checking accounts, the money stock is called M1. And so we have M1, which is the money stock. This is currency and demand deposits. Then we have what we call M2, which consists of M1 plus savings accounts. In other words, M1 is extremely liquid, whereas M2 is a little less liquid in terms of when you put money into savings accounts, you're doing so because the bank itself is paying you a small interest rate. And so it makes the savings accounts a little more less accessible than it does, say, the checking account or the currency that you have. It also consists of mutual funds and certificates of deposit, CDs. In all three cases, these items draw interest. So M2 consists of accounts that draw interest over time, so they encourage you to save, and while at the same time also consisting of the money stock, in other words, the demand deposits and the present currency. And so each of the three pay households interest for the use of their income. And then we have what we call M3, which is M1, M2, plus time deposits like CD, but in much larger amounts, over $100,000. So we see these three types of money within the economy, and basically it's just a reference really to how quickly can we get access to it. M1 is the most accessible, M2 is a little less accessible, M3 is a little less accessible than M2. So we can kind of break it down. Essentially, M1 would be like 1.4 trillion. M2 is like 6.5 trillion. So that's, remember, M2 plus M1. And then M3 would be the total. So the total amount of supply, the broader medium of exchange and store value, it would be 9.6 trillion based on what we're looking at here. So you'll notice what's included in M1, currency, checking account balances, and traveler's checks. Whereas M2 are the savings accounts, the small time deposits, these types of things. And then M3 are the large denomination time deposits. For example, like we said, very, very large CDs that are over a long period of time, right? And institutional money like market fund shares and different things, investments. So that's kind of how this breaks down. And like I said, the reality here is it's a question of how easily accessible is the money when we need it. So let's look at the money supply from 1980 to 2015. So what you'll notice when you're looking at the money supply, you'll notice here 1980 we're under 200, that's in 200 billion is of dollars, you'll see that. By 2007 you'll notice we're up over probably around 7, so it keeps going up. You'll notice there around 2010 that little kind of peak where it levels off a little bit, and then it continues to go up. The main bottom line here is what we notice, of course, with the money supply is that the money supply tends to trend upward, which is important because if the money supply is trending upward, then that's what we also know about price levels. They tend to be trending upward as well. So open market operations give the Fed the ability to control the money supply. Remember, this is the buying and selling of bonds. A second way they can control the money supply is through changes in the reserve requirement. An increase in the reserve requirement decreases the money supply. A decrease in the reserve requirement increases the money supply. And the reserve requirement is the percentage of deposits banks must keep on hand at all times. In other words, banks don't hold every dollar of deposits, nor do banks loan out every dollar of deposits. There's a certain percentage which they have to keep on hand. Now, as that requirement increases, the less money that is there then available for loan. So for example, if it goes from 10 to 50%, then what that would mean, of course, is that the amount of money that they have available to loan out is thus reduced, and thus that would decrease the money supply over time. So when the requirement decreases, there's an increase in money available for loans. If it goes from 50 to 10%, all of a sudden now they don't have to hold as much, thus more money then can be loaned out. So if the reserve ratio were 1/20, so we do the percentage there, that's 5%, then the banking system would have 20 times as much deposits as in reserve. So to kind of give you the idea here, $1 in reserves would equal $20 in the money supply. So at a reserve ratio of 1/20, $1 in reserves equals $20 in the money supply. So if the reserve requirement was 50%, 1/2, then the money multiplier is 2. So $1 would generate $2 in the money supply. So notice that as the reserve requirement increases, the amount of money that $1 in reserves generates goes down. And we're going to pick this up again when we talk about fractional banking. It'll give you a really, really good idea as to how the banks generate money within the economy. So this term money multiplier, I used it just a second ago in reference to the reserve requirement. So to determine how much money each dollar in reserves generates within the banking system, economists use the money multiplier. And it's the reciprocal of the reserve ratio. So M is equal to 1/R, and R being the reserve requirement, which is also the money multiplier. So 1/R, for example, with a reserve requirement of 20% would be 1/5. So then that would mean that for every dollar in the economy, well, every dollar in reserves would generate $5 in the money supply. So really what you're looking for is if you see a percentage of 20, 25, whatever that percent is, convert that to a fraction, because then that's going to tell you how much $1 will generate within the money supply. So if the reserve requirement was 75%, for example, then you could convert that to a fraction and get a better idea of what's happening within the economy. So M is equal to 1/5, or the multiplier is 5. So if there are $50,000 in deposits with a money multiplier of 5, in other words, 1/5 or 20%, then what we know is that $50,000 would generate $250,000 in the economy. And that is how we see constant inflation. In other words, the Federal Reserve has a lot of difficulty in controlling the inflation rate, price level increases, because it's not an exact science, number one. And number two, because of what the banking system is able to do, is able to generate. You know, the fact that a $50,000 deposit can generate $250,000 in the economy because of how much is being held in reserve, that gives you an idea of how difficult it is to control price levels. Okay, so we've looked at two methods so far for how the Federal Reserve controls the money supply. Open market operations, which is the buying and selling of bonds, and then the reserve requirement, which determines how much money banks have to keep on hand at all times based on what their deposits look like. So the discount rate is the third method, and it's the discount rate is the interest rate the Fed charges banks for loans. So when banks borrow money, they have to pay it. They have to pay just like people do in terms of an interest rate. So that interest rate moving up or down determines how much money they're actually going to ask for. So increasing the discount rate decreases the money supply. So by increasing the discount rate, by increasing the interest rate, this decreases the money supply. By decreasing the discount rate, it increases the money supply. And we can see that here. So this is the same line graph we did with households, but the same essential fact it's applying here. As interest rates go down, the quantity of financial capital demanded goes up. So if the Fed wanted to increase the money supply, one of the things they could do is lower the discount rate. That would increase the amount of financial capital that banks are borrowing and thus loaning out to other people. If the Federal Reserve wants to decrease the money supply, then what they can do is they will increase interest rates. And by increasing interest rates, say from what we look here, if we look at A, we're going to reduce the amount of financial capital that banks will demand. So if we take point A and we go up to point B, by raising the interest rate from 2.3% to say 4%, we're reducing the financial capital the banks are demanding from just over 8 to down to just under 6. So the interest rates is the fast way for the Federal Reserve to increase and decrease the money supply, because it's going to impact banks immediately. So we see this movement taking place in terms of how we're controlling the money supply, because if you decrease interest rates, then you're going to increase the money supply. Increasing the money supply, of course, is going to increase aggregate demand. So when we go back to the monetary policy, decisions made by the Fed to increase or decrease the money supply, they have 3 methods to control the money supply: open market operations, reserve requirements, and discount rates. Monetary policy in the short run, though, is based on the Fed's ability to influence the money supply through interest rates. If the Fed wants to quickly make a change in monetary policy, then they can change the interest rate, because that will immediately affect the amount of money in circulation by what banks are borrowing and what they're not borrowing. So the raising and lowering of interest rates creates changes in aggregate demand, which in turn affect real GDP. That's why we spend so much time on looking at how the economy fluctuates. It's because of how easily aggregate demand can shift based on the amount of money that's in the market, and the money supply. So in the short run, changes in the money supply affect the economy through changes in interest rates. So let's look at the short run monetary policy. So in the short run, a lower interest rate encourages households to spend more and save less. It encourages business to invest more as well. So lower interest rates mean we're going to put more money into savings accounts, and it also means that businesses are more likely to borrow money. Thus, lowering interest rates serves the purpose, of course, of increasing price levels. It generates money within the economy, so it creates inflation. Now, more consumption and greater investment increase the aggregate demand. So a lower interest rate shifts aggregate demand to the right, thus increasing employment and outrun in the short run. Now we know that, of course, because this is one of the things we talk about with Phillips curve, is by increasing inflation rates in the short run, we're also going to decrease the unemployment rate, because more workers will get hired. So the actions of the Fed concerning interest rates try to bring the business cycle in line with the trend line. And that's the primary goal here, is to make that business line be as close to the trend line as you possibly can. So when we look at this line graph, we'll notice here we've got short run aggregate supply, and here is our aggregate demand. Now what it says here, of course, is as interest rates lower, aggregate demand shifts to the right. So that's what we see. Now what you'll notice, of course, is we go from this equilibrium to this equilibrium. So we see an increase in price levels, but we also see an increase in real GDP aggregate output. So this gives us an idea of what's taking place. Now, if you'll remember our discussion on with the economy fluctuating, short run and long run aggregate supply are different. Long run is a standard vertical line. So long run monetary policy only influences price level, does not influence the factors of production. So it does not influence real GDP. Since in the long run, the factors of production are not affected by changes in price, an increase or decrease in price level doesn't matter. So when we talk about monetary policy, we're really looking at the short run, because in the long run, the monetary policy does not affect the factors of production, because those are already set. We can look at it and we know that those are only going to change with significant changes, say in population or technology or something of that sort. So when we look at it here and we put our long run aggregate supply curve up, so if we have aggregate demand 1, and we see an increase in price levels to aggregate demand 2, all we've done is kept the exact same amount of real GDP, but we just have raised the price level, what it's going to cost us now to purchase that that aggregate output, that real GDP. So you can look at it here when the price level is in one location, it moves to here, there's the new price location. So we see it goes from just over 120 to about 158 or something in terms of the economy. So when we see this increase here, what we notice, of course, is that all of a sudden now our price levels are higher, work levels are back to the same level. So, but it's that constant fluctuation in the short run, whereas in the long run, like we said, factors of production aren't changing in the long run.